This is our disclaimer, which I'm required to pause on for a minute. Okay, so I think the first thing to start off with is context. I think context is really big. You have to have context to kind of understand how tax rules work. And so we have to go in the time machine back to 1980, and that's when FIRPTA was introduced. And so we see that came through in starting in 1981. So the legislation was passed in 1980 at the very end of the year and goes into effect starting in 1981. But prior to the legislation, if you were a non-resident alien and you owned US real property and you sold it, there was no tax due on the sale of that real property. And in the United States, we don't have any prohibitions against non-US people owning US real property. So prior to 1981, you could have owned any type of real property, sold it, and not had any kind of tax apply. But in 1980, at the end of the year, they passed the FIRPTA, and the original amount, the original withholding tax was set at 10%. They also deemed the sale of US real property to be what we call effectively connected income, as opposed to non-effectively connected income. We'll talk a little bit more about why that's important later. And then last but not least, the act basically says that if you do have a sale of real property, regardless of whether or not there's withholding tax, because it's effectively connected income, you do have to file a non-resident tax return. And we'll talk about some of the IRS enforcement around that aspect, because there's a lot of folks that have sold the real property in the US, non-residents have sold real property and have not filed the 1040 NR to follow up with whether they owe tax or not. That's something that they probably need to close the loop on. Internal Revenue Code 1445 is kind of the second part of FIRPTA. So if you go back to that slide I just showed you, the FIRPTA rules fall under Internal Revenue Code 897. But from an enforcement standpoint, it wasn't really until 1445 gets enacted 4 years after FIRPTA, as far as the imposition of the withholding tax obligation on the buyer. So 1445 says that the buyer of the US real property is basically responsible for the withholding tax. And if they don't remit the withholding tax, then the buyer is actually liable for the tax that the seller must pay. And that's a big, big deal that I think a lot of buyers don't realize when they're entering into a FIRPTA transaction. So you have a non-US person, they're the seller of the home. They sell the home, they have to get the buyer's information to be able to sell the home. That has to be disclosed to the IRS. And if for some reason the seller doesn't remit the tax, any tax that's due on that transaction under FIRPTA, then the buyer is liable for that. And that's Internal Revenue Code 1445. We fast forward to the PATH Act of 2015. And again, we start with 1980 to 1981 is the beginning of FIRPTA. 4 years later, we have 1445, and then we get the PATH Act. And what does the PATH Act do? The PATH Act increases the withholding tax rate from 10% to 15%. So this is a revenue generating portion of the PATH Act. It's saying we want to get some more revenue out of this. We want to protect our interests. I think at this time in 2015, they were seeing a lot of folks that were not withholding the correct amount of tax. So very large sales over $1 million, not withholding the proper amount of tax. And they wanted to really enforce that and make sure that they were getting their cut before a non-resident left the United States. So we see the increase from 10% to 15%, as you can see in the legislation that I copied and pasted on the left-hand side of the slide. That's basically updating Internal Revenue Code 1445. Now, there's some other obscure changes that are occurring in the PATH Act related to FIRPTA about REITs and domestic corporations and foreign pensions. But really for individuals, which is what this presentation is geared for, you just have to know that the PATH Act increased the withholding rate from 10% to 15%. And I think there's a lot of misunderstanding about the changes at this point in time, because I have a lot of folks that will tell me that FIRPTA, regardless of what the sales price is, the withholding tax should always be 15%. And in fact, I'm dealing with a client right now that sold their home for $250,000, and the title agent withheld 15% of that, which is completely improper. So there is some confusion that comes out of the PATH Act in regards to those changes. Okay. I'm just going to say this briefly because, again, this presentation is not geared, and I'm going to talk about that here in a minute, not geared towards foreign corporations or partnerships, but There are some different withholding provisions when you get into those structures that people just need to be aware of. So if I have a foreign corporation, sometimes called a blocker company, that owns US real property, it's a common structure, or used to be a common structure to shield against estate tax for non-resident aliens. That corporation would have to withhold 21% under current law. And if the Biden tax plan is passed as it's written in the Green Book, which was released May 28th, then potentially the withholding tax would increase to 28%. Partnerships have different rules, and that's going to put you into 1446, which there's a whole slew of updates for. And then the withholding forms for that are going to be the 8804 and 8805. So again, just to set the tone here, this presentation is pretty much geared around individuals and income tax with a slight bent towards the G4 visa holder. So things that we're not going to be talking about, I'm not going to be talking about state withholding tax, which in some states would apply to these transactions, gift tax, estate tax, imputed rental income. So sometimes we see, foreign owners of US real property, perhaps letting people use their real property. There could be quote unquote imputed rental income in that situation. Home country taxation. So when you sell US real property, you're dealing with the FIRPTA rules, but perhaps you have, if you're a resident of another country, you may have some reporting obligations and tax obligations there as well. I'm not going to be talking about prior compliance. So if you haven't got your net election correct for rental property, or you haven't done something properly for prior filings, that's a whole different topic. I'm not going to go into trusts or 1031 exchanges. I'll briefly discuss LLCs. There's an intersection there with FIRPTA. And I talked just briefly on the previous slide about corporations, partnerships, but those are not going to be part of this presentation. Okay, so let's get into the meat and potatoes of the presentation. So the first thing to know is that FIRPTA is going to apply to a non-resident alien. And so you have to kind of define out what is a non-resident alien. And the way that we define a non-resident alien is we say it's anything that's not a US tax resident. Well, what's a US tax resident? A US tax resident is going to fall into one of three categories. They're either going to be a US citizen, a US permanent resident, otherwise known as a green card holder, or they're going to be an individual satisfying the substantial presence test. Those three categories are going to technically be US tax residents. The big one here to note is the substantial presence test, which is basically a 3-year formula. So different countries have different tests for tax residency that normally look at 1 calendar year. The United States, being the United States, we like to be very unique about how we do things. We use a 3-year period. So the days of presence in the current year count as 1 day, days of presence in the prior year count as 1/3 of a day, and the days of presence 2 years prior is 1/6 of a day. You then add it all up, similar to the little table that I've got snipped in the right there. And if the total number exceeds 182 days, then you're a US tax resident. Now there's some other little nuances there. Like for example, you have to have a minimum of 31 days inside the US in the current year for that to even start, right? For that to even qualify. But generally speaking, it's going to be this 3-year kind of look back test that we're going to look at to see if someone's a tax resident under the substantial presence test. Now, with international organization employees, we have to understand that most international organization employees that are on a G4 visa are going to have their days exempt from counting. So they can never satisfy the substantial presence test, even though they're physically located inside of the United States. The same would be true for certain diplomats under the A visa, and then for certain students / trainees and teachers under the F, J, and M visas. So you have to be careful when you're dealing with tax exempt individuals that are physically residing here in the United States. A lot of those folks will have to deal with FIRPTA because they'll be non-residents for US tax purposes. And again, here's the code section that refers to the days not counting for full-time employees of international organizations. It's Internal Revenue Code 7701B. And then full-time employment is typically for international organizations a 40-hour work week or the equivalent. Certain international organizations will define the equivalent of a full-time employee to be based on whatever they determine. So again, I like to talk to the G4 visa holder and just make sure that they're not getting, they haven't been put in a part-time equivalency status or something less than what would be deemed to be a full-time employee Otherwise, their days in the US might count for purposes of the substantial presence test. Okay, so withholding tax. The withholding tax typically is reduced from 15% to 10% when certain things are met. And if you look at the right-hand side of the slide, you can see where it's indicating some of those changes. So first off, the buyer of the property must use the property as a resident, or at least have the intent to use the property as a residence. So the buyer must be an individual, not a corporation. They must use the property as a residence for 50% of the time over the next 2-year period. And you evaluate the next 2-year period over 12-month blocks, because no one really buys or sells property on January 1st or December 31st. So we look at 2 12-month blocks to determine the usage of the property. But if your buyer is typically an individual, they're probably going to use the property as a residence. So that requirement will be satisfied. And then the reduction, what will happen is if it's less than $1 million, the withholding tax is 10%. But it has to be more than $300,001. So between those two line items, $1 million and $300,000 is where the 10% withholding tax applies. Anything over $1 million, you're going to have a 15% withholding tax that applies. Anything less than $300,000, there is no withholding tax at all. Okay, and so what we see is in the Internal Revenue Code 1445B5, it basically says that there is an exemption of withholding tax if the sales price is $300,000 or less. So I go back to my original comment at the beginning of the presentation. I have a client, G-4 visa holder, sold their home for $250,000. If it was an apartment for $250,000, the withholding agent, didn't let him out of it. Said, "Hey, you got to withhold 15%." They withheld the 15%, remitted it to the IRS, which was completely incorrect. And now we're having to take an enormous amount of time to try to get their refund back. So make sure, and if you look at the IRS guidance on this, it basically says it's your duty to inform your settlement agent or your closing agent, whoever you're working with, about this exemption, but make sure that they understand that there is an exemption. You do not need to do withholding tax if the sales price is less than $300,000. Okay, so again, this just summarizes on the left-hand side what I just said. So if the sales price is more than $1 million, it's a 15% withholding tax. If it's between $1 million and $300,000, it's 10%. And if it's less than $300,000, it's 0%. And what happens under the general FIRPTA rules, and we'll talk about exceptions here in a little bit, but under the general FIRPTA rules, the withholding agent or closing agent, typically the escrow or title, will withhold at the 10 or 15%. They will issue a check from their escrow account, which will have the withholding tax, and they will send those funds at closing to the IRS within 20 days, along with forms 8288 and 8288A. And I'm going to go through the forms and talk about those here in a minute. But I do want to point out the 20 days. The payment must be made within 20 days of closing. That's the rule. And that's a big, big rule that a lot of people overlook. They don't realize that that payment must go in within 20 days. And even worse, it's the buyer's responsibility to make sure the payment goes to the IRS within the 20-day period. And if it doesn't go within the 20-day period, then potentially, not always, but potentially the buyer could be in some hot water with the IRS about making a late payment. Okay. So this is a snip of Form 8288. It's just 1 page in length. It's not too crazy, but I do see some people kind of completing it incorrectly. And I'll be honest with you, the IRS probably gets a lot of these that are incorrect, but they do a good job at correcting it for you. But generally speaking, when you're selling the property to an individual, you complete part 1, lines 1 through 6. Okay, and you disclose the name of the buyer, the description of the property, the date of transfer, the amount withheld, and the amount subject to withholding tax. It's a pretty straightforward filing. And again, this is not completed by a CPA or a tax preparer. This will always be completed by the settlement agent or whoever's holding the funds in escrow. If the buyer is an entity like a corporation or an LLC, then they're going to complete part 2. So that's the differentiator. Part 1 is for an individual. Part 2 is for an entity of some sort. And then when the IRS gets the form, this is kind of the markup that they do, because it's a manual submission. You're not e-filing the form, okay? Basically what's happening is that the form is filled out, it's signed, it's sent into the IRS by mail. Hopefully it doesn't go into the backlog of 30 million parcels that they're currently experiencing. But once they get it in Utah, they will then take the form and they'll do this mock-up and they'll make sure that everything kind of ticks and ties out. Along with the 8288 and the withholding check, they'll need to complete Form 8288A. And this is the most important form of the whole process if you're going to allow the withholding tax to occur. I stress this so much when I talk to people over the phone that this is the big thing that you have to be careful with. And I've highlighted the sections that you need to make sure are done correctly. So the first one I've highlighted is the identification number, which a lot of non-residents get tripped up. They're like, what's my identification number? I don't understand what that means. The identification number is either going to be your US Social Security number, if you have one, or if you don't have one, what's called an individual taxpayer identification number, or ITIN, okay? So you have to have that. The IRS has to know where to put the money. If you leave that blank, then that's a problem because the IRS has nowhere to route that money to. There's no tax account it can put it in. You also need to make sure that your name of the person, so your name, if you're the seller, your name is correct down to the middle initial. If that's how you file a tax return, then it needs to match what's on the tax return. If you've never filed, then it should match your Social Security card or ITIN application or whatever it is going on there. But the name has to be correct. I've seen so many people file with names, nicknames, and things that don't make sense. You have to look at it closely and say, hey, what name am I actually using on this form? Is it the correct name? Is it going to match up when it goes to the IRS? Okay. And then the mailing address of the person. So that's really important. And I'll talk about that here in a minute, but you just have to make sure that whatever address you put down, whether it's the foreign address or the mailing address, it needs to be an address that you can actually check your mail and see if you get responses from the IRS. It's very, very important. Don't put an address that you're not going to have access to. And definitely do not put the address of the home you just sold, because then the mail will go to the buyer and the buyer will probably send it back to the USPS. So here's an example of a snip that I took from the IRS IRM about a completed form. I actually don't think this was done right because they didn't indicate who the person was that was subject to withholding. I think you need to check this box here in line 6. But again, this is just an example of what it would look like filled out. Okay. So a common question we get, and this is where I think things can go wrong really quickly because people just simply don't ask. They say, oh, you're a G4 or you're a non-resident, you're selling real property. Sure, we can do the form. We can do the 8288, 8288, 8288A, 8288B, whatever it is. They don't stop to ask, do you have a US Social Security number? Do you have an ITIN? Okay. Always confirm that first. And if you're eligible to get a Social Security number, so if you're a US citizen, then you need to go to the Social Security Administration and get a Social Security number. If you're eligible to get a Social Security number, then you can't get an ITIN. You'll get a letter that'll say that. It'll say, hey, you've applied for an ITIN, but you're actually eligible to get a Social Security number. You need to go do that. If you're not eligible to get a Social Security number, which most non-residents would be ineligible, then you need to get an ITIN. And the way that you get an ITIN is that you complete the form W7. And if you look to your left, that's a snip of the first page of the form. Now, right now with COVID-19 happening, or kind of on the tail end of COVID-19 here, it's very difficult for a lot of folks to get ITINs. We have a general policy that we complete the form and we send folks to acceptance agents. We have the acceptance agents sign off and everything for the client and then send that into the IRS. And even when that occurs, it's still about a 50-50 chance as to whether or not the IRS will process the form correctly. So you have to take great care to make sure that you get your W7 done correctly if you need to get an ITIN. Okay, so assuming you've completed all the information correctly and you've got your ITIN, your social, the mailing address, all that stuff, the big thing is that when the IRS gets the check and they get the 8288 and 8288A, they're going to cash the check which they'll do immediately. So the first thing they always do is cash the money. And then they're going to link the withholding tax to the taxpayer account. Once that's all said and done and everything is ticked and tied with the IRS, they're going to stamp, literally with a red stamp, the form 8288A, and they're going to send it to whatever address you put on there. So that is super critically important to make sure that you get the stamped copy back. Why is it important? Because the IRS is not going to give you your money back when you file your non-resident tax return until you get the stamped copy and you give it to them. So they send you the stamped copy back. Then when you file your non-resident return, you submit that with a copy of the stamped copy, and then they give you your money back. It makes the process go a lot smoother and a lot faster. For COVID-19, there was some significant delays, not only with cashing the checks, but also getting the stamped copy back. So I know some people are still waiting for their stamped copy. What we've done at the Wolf Group is we've gone ahead and filed the non-resident returns without the stamped copy. And then whenever the IRS comes back to ask for the stamped copy, typically by then our clients have the stamped copy. We can then remit that to someone at the FIRPTA unit, and that should close out the transaction and get the refund. But again, this is the golden ticket. You got to get the stamped copy and you got to set yourself up for success. Okay, what if a married couple sells US real property and they are both non-residents? The way the rules work is that there's kind of an assumption that both spouses have equally contributed to purchasing the property, and therefore both spouses get an equal portion of the realization or the gain when they sell the property. In turn, what happens is that if you have withholding tax for a sale of property for married people, they should split out the withholding tax between both of them as well. So there should be two 8288A forms that are completed, one for spouse number one, one for spouse number two. And then what happens is that each spouse will file their own non-resident tax return because non-residents can't file jointly. And they will report half the gain and half the withholding tax. And that's how the transaction will go through at the very end with the IRS. I get this question a lot, and it normally comes from people that have good intentions, but the question always comes to me, well, what would happen if I were to open up a US LLC, a limited liability company, and put the real property in there? Would that then override FIRPTA, and can I not have to do the withholding tax? The answer is no. The reason is because we look through the LLC and we look to the status of the primary member, which will be a non-resident alien. In that case, the LLC cannot shield or override FIRPTA. In fact, there's very little that can override FIRPTA. So there's not a specific way, I think, to get around FIRPTA. I would just deal with FIRPTA instead of trying to get around it. But this question is asked a lot. The downside, though, that I tell a lot of people about opening up the LLC, especially if you're a non-resident alien, is you're in it for a penny, in it for a pound, and now you're going to have to file the disregarded, assuming it's a disregarded entity, the disregarded entity filing, which is the 1120 page 1 form 5472 filing. That's an annual filing that you have to do. If you get that wrong, that's a $10,000 or $25,000 penalty now. Previously in 2017 it was 10. They jumped it up to 25 in 2018 and so forth. And then there's a new FinCEN form. FinCEN is obviously the organization that pushes the FBAR, but there'll be a brand new one for beneficial ownership disclosure starting in 2022. And failure to do that one correctly or even timely is a $10,000 penalty. So I think creating the LLC for circumstances like this actually creates more problems than it solves. And frankly, due to the types of disclosures that you have to do with it, I tell most people it's really not worth it. It may be worth it under certain circumstances, maybe estate planning in other areas, but for this particular item, I probably wouldn't do it. I also get this question a lot because we deal with a lot of folks that are making 6013G elections. So what happens if I'm married to a US citizen or a green card holder and I make a 6013G election for the year in which I sell the property? Can I tell them I'm a tax resident and not have the withholding apply to me? The answer is no. The 6013G election does make most folks a tax resident, but it does not override FIRPTA. So you can't make the 6013G election to get out of FIRPTA withholding. Okay. What if my spouse is a US person, but I'm a non-resident alien? So this is another question we regularly get. What will happen is that they will use the sales price, the full sales price, or they should use the full sales price to determine the withholding rate. So if you and your US person spouse are selling a property for $1 million, then it should be the 15% withholding rate. And then what should happen is it should be 15% of 500,000. That's what would be remitted for the FIRPTA withholding, because only one person is a non-resident. And in some cases, I've seen them actually do the full FIRPTA withholding for both the non-resident and the resident, which is incorrect. So you have to be careful about explaining the rules to, again, the settlement agents. There's a lot of confusion when you get into circumstances like this where it's not straightforward. Another area of confusion is what we call the 121 exclusion. So I see this a lot. People don't realize that if you live in the real property, you're a non-resident alien, you're maybe a tax exempt individual like a G-4, you're living in the property for 2 out of the last 5 years, each individual person gets a $250,000 exclusion of gain, a $500,000 if you're married. A lot of non-residents assume that doesn't apply to them, but it actually does. So again, A, G, F, J, M visas, you may be able to take advantage of what we call the 121 exclusion. And make sure you factor that into your calculation when you're going to sell the property. Okay, so what happens if the buyer, like let's just say that you're selling the property and you don't disclose that you are a non-resident alien, and the buyer never transfers the withholding tax, and later on they find out that in fact the seller was a non-resident. What will happen, what should happen, and maybe it's not been happening, but it may happen more in the future due to IRS increase in staffing and budget. But what should happen is that the IRS would assess the withholding tax plus penalties and interest against the buyer. Now the buyer can seek relief from the penalties under Rev Proc 2008-27. So there is some things that are helpful to the buyer in those circumstances, depending on how it plays out. But again, the buyers have to be very, very careful to make sure they know all the facts of who they're purchasing the home from. Okay, so what are my options? I just gave you the general rules for FIRPTA, how it works, what happens there, the 8288, the 8288A. What other options do I have? Well, in my world, there's only three real paths that you can fall under, okay? You can do a request for a reduction. You can allow the withholding to occur and do a claim of refund, or you can allow the withholding to occur and do the claim of refund on a non-resident tax return. So I'm going to go into all three of these and walk you through them. So the first is requesting a reduced withholding certificate. And there's a lot of Treasury regulations. There's a super helpful Rev Proc that kind of explains the whole process here. And there's even a publication 515, that kind of tells you exactly how to do this. But the way it's going to work is you're going to prepare Form 8288B. You're going to do your tax calculations, which again, I would have a professional do. I wouldn't want to dabble or do that myself. You are going to submit that, or you should submit that as early on as possible. And typically it's when you get a purchase and sale agreement. So a lot of times, or back in the good days, the pre-COVID days, I would tell my clients like, hey, tell me when you're going to put the house in the market. Tell me when you get a purchase and sale agreement. As soon as they put the house in the market, we mark up the 8288B, we do all of our calculations. We, except there's some things obviously we don't have the numbers for, but as soon as we get a purchase and sale agreement and we know the purchase price, we throw that number in there, we finalize the documents and send it out immediately to the IRS so that they can take a look at it. They have 90 days to act from when you send that out. So it's a tight window to get it done to meet all the timelines. But if you do that as quickly as you can, you're setting yourself up for success, or at least pre-COVID, that was the way that you kind of acted on it. And this is kind of the checklist, if you will, of things that I typically ask from my clients in order to make sure that I'm doing the 8288B and all the calculations correctly. It's a laundry list, it's an Easter egg hunt. I apologize, but this is literally all the stuff you have to go get to make the whole thing work. And a lot of times things fail to work with 8288Bs because they're either incomplete or you're leaving some gaps in what you're submitting, and the IRS won't let it go through. Their default is to not approve the 8288B. So you really have to have a clean filing to get the whole thing to work properly. Okay, this is the 8288B form. It's also one page, but there's a lot that has to be kind of attached to it. And so typically when we're doing 88B submissions, they're actually quite thick and you have to mail them into the IRS. The front page just kind of walks the agent through exactly what you're submitting. And I've seen a lot of these prepared incorrectly or not prepared properly or missing information. So there's a lot of ways that this form could go wrong just by not doing the first page of it. If you get your approval, you're going to get a really cool letter. And it's kind of like your, hey, I'm good to go letter. It's going to look a little bit like this. And it's going to have kind of this language in it, hey, we've approved your withholding certificate. This is your legal notification that the withholding is going to be X, and that you need to submit Y. If there is some leftover amounts that need to be submitted, this is what you need to submit with the 8288 and 8288A. This letter is really for the withholding agent to tell them what to do and how to do it and give them permission on what to do next. And so there's 4 different outcomes that I typically see when it comes to the 8288B submission. So you do the 8288B when the purchase and sale agreement is signed. You send everything to the IRS. You do it as early on as possible. The approval letter arrives before closing. There's a reduced withholding amount. There's the release of funds at closing. You don't have to do the 8288 or 8288A unless there's some leftover withholding tax that needs to be remitted. And then later, the sellers go back and file the Form 1040 NR, which is basically a zero filing. It just closes out the loop with the IRS, and everybody's happy. It's a great outcome. Outcome number 2 is the same for the first 2 steps, but what happens is that the letter arrives after closing, but before the 20 days expires. Then you still have the reduced withholding if it arrives before the 20 days expires. The funds are released, and again, great outcome. Outcome number 3 is that the approval letter arrives after the 20 days. And in reality, what happens is that they'll actually hold on to the funds. They won't go ahead. A lot of times what I see is that the closing agents won't follow the 20-day rule. They'll hold on to the funds for a long period of time, and with hopes that the 8288B will come back and that the approval letter will be there and it will match what the seller indicated. But what should happen is after the 20 days, the tax should be remitted on the 8288 and 8288A, and then a claim of refund can be filed immediately, or a Form 1040 NR be filed in the following year for the previous calendar year. So that's outcome number 3. And then outcome number 4, which is the worst of all scenarios, is that a denial letter comes through. And if a denial letter comes through, then the tax needs to be remitted to the IRS with the forms 8288 and 8288A, and most importantly, a copy of the denial letter must go down with those forms so that there's no penalties or interest for the buyer. And I think a lot of folks miss that. And that's a concern I've had through COVID, because if no denial letter comes and people are just remitting the withholding tax after the 20 days, if the IRS wanted to be sticky about it, it could create problems for the buyer. Although I haven't seen that occur very much. I did see it occur a couple of times last year, but it hasn't occurred as much as I thought it would. Okay. Denial letters typically come in waves. So what happens is that if they deny the requestor, you're going to get the 3313. In some cases, they may want additional information, and that would be the 3316. And then if no one responds to that one, then they're going to send out a 3543. And if no one responds to that one, then eventually they're just going to deny the whole thing, and the transaction will be denied in full. But that's typically how the denial letters are classified. I think the approval letter that I showed you was the 3310, if I remember correctly. But those are the series of letters that the IRS typically uses for both approval and denial letters. Common mistakes for the 8288B. So the big one that I see a lot of is there's no ITIN or SSN provided. I mean, it's like, I look at it, I'm like, whoa, step 1, get your ITIN, get your SSN, put it on there. There's incomplete or inaccurate buyer information. You got to get with your buyer and say, hey, I need your full info. I need your social. I know that's a big ask, but in these situations, you've got to disclose it if you're going to do the 8288B. Some people will list the closing agent as both the withholding agent and the buyer. You can't do that. That's obviously not correct. You're not providing enough substantiating documentation. So if you had $200,000 of capital improvements, then you got to prove it. And if you don't prove it, they're not going to buy it. They're going to mark it off. You're not calculating capital gains tax correctly. So maybe you're just saying, hey, I have $100,000 of gain. I think that's a 20% tax. Therefore, I think the tax is, $20,000. Obviously, that's not how it's not straight like that, capital gains tax. So you'll have to kind of walk through, the math a little bit more to make sure that it's calculating out correctly. If you have a rental, then you have to include the depreciation recapture. You may have some suspended passive activity losses, which we call PALs. Those things have to be accounted for properly. And then if the IRS does ask questions, you need to try to respond to that as quickly as possible. So really important to follow up with any questions that they may have. If you're offshore and you're doing the 8288B process and you're worried about correspondence, there is a procedure that you can follow. And if you look on the right-hand side, you can request that the certificate go to the closing agent, but you have to put that in the box 5 of Form 8288B. That's kind of an end around to make sure that the correspondence is going to someone who's actually going to receive it, look at it, and do something with it. Okay, what if the seller does not have an ITIN and wants to complete the Form 8288B? Well, what you do is you'll complete the Form W7 that I mentioned earlier for the 8288A. You'll attach that with the Form 8288B and all the items that I just talked about for substantiation. And then there's an address that you'll send that to in the W7 instructions. According to the IRS, and I've never seen them move this quickly on anything, once they get that request, they're supposed to process it within 10 days. I have never in my life seen them process an ITIN request in 10 days. In fact, if I saw that, I'd probably fall off my chair and have a little bit of a heart attack. But that to me is not a real timeline. I think you're going to have to wait a little bit longer for that. And that's going to cause actually in the COVID period or post-COVID period, I think it's going to be a very much elongated timeline with a low success rate. So if you need an ITIN to do the 8288B or 8288A, I would say get started on that as soon as possible. And if you want to learn more about that, you go to irs.gov and you type in this ITIN guidance for foreign property buyers and sellers, and that has a good kind of rundown as to how to do that process. Speaking of process or processing time, it's been my observation since the pandemic, and remember, the IRS closed in mid-March and formally reopened on August 1st, although we do know that there were employees that were returning from remote work in July of 2021, but formally reopened in August 1st, 2021. That has put the IRS significantly behind. I mentioned earlier that there was a 30 million parcel backlog consisting of 2019 and 2020 tax returns. It also consists of responses and mailed-in items like the 8288B. It's my observation that the FIRPTA is about 8 to 12 months behind on responding to requests. So if you kind of rewind that process, you're looking at requests made in June or July of last year is probably what they're working on right now. Now that will speed up. That as time moves forward, the IRS is going to get less and less correspondence. It's a little bit busier at the beginning of the year due to the filing season, but as time moves forward, they will get faster on it. They've also got an increase in budget and new funds from the federal government. So as they hire more people and they kind of get back to proper staffing levels, the timeline will speed up. But for right now, with the FIRPTA unit, it's about 8 to 12 months behind. And what we're seeing is a variety of responses. Some are, obviously not timely. Some are inaccurate. And in some cases, we see no response at all. So there can be a wide variety of issues that come out of the processing. Okay, FIRPTA options. So the second option you have here is to allow the withholding to occur and request a claim of refund after closing. So the way that works is they do the closing and they send out the 8288 and 8288A. And then immediately what you do, and you got to do it real quick, is you complete the Form 843 and you basically attach the same things that you did with or you would have done with the 8288B. It's the same documentation, same information. The problem with this filing that I dislike, and it's not that I don't want to do it or it's not a good option, it's just that it has to be mailed into the IRS. So it goes into the mail backlog, and that can take the processing time to be very extreme. But it is an option, and you can actually do it conjunctively with filing a 1040NR, which you have to do anyway. So in some cases, some of our clients have requested to do both the claim of refund and the 1040NR, get both processes going when you can, and eventually one of them should get you to the answer that you're looking for. Which brings me to the third FIRPTA option, which is doing the allow the withholding to occur, and you do the non-resident tax return, which is what most people are doing. To me, this is the cleanest way to do it because you get the stamped copy of the Form 8288A, which you may need to get anyway. I call that the golden ticket. You do your 1040 NR, you file it, you submit a copy of the stamped copy of the 8288A, and then it takes roughly about 6 to 9 months. That's the normal cycle time. So some people will say, hey, Mish, it still says refund, processing when I check irs.gov. And I say, it's going to do that. It's going to do that for probably till September or October. That's how long it's going to take them to verify everything and make sure that they're giving back the proper amount of money. So it's a waiting game. If you're going to go this final third option, just know that it's going to be quite some time before you get your money back, about 1 to 2 years in length. Okay. The Form 2848, which I think is one of the most underutilized forms when you're engaging a CPA or a tax preparer, or even an attorney that does tax. I think the 2848 is fantastic because it allows the tax professional to be designated as the personal representative of the client with the IRS. It allows the tax professional to access the client's master file. So then, I can ask for statute of limitations dates. I can check transcripts. I can, respond to notices and correspondence. If the IRS wants to talk to the client, they actually have to talk to me first instead of talking to the client first, so you don't get any scary phone calls. I look at it as the thin red line between the IRS and the client. But with FIRPTA transactions, it's even more imperative, in my opinion, because you're having someone that can quickly call in if they're able to get through to the IRS and to figure out what's going on there, to maybe make sense of what's happening, to track refunds, things like that. So I would say, regardless of who you're dealing with, regardless of whatever professional you're dealing with, if you choose to work with a professional for FIRPTA, my advice is to have that person do a Form 2848, declare them to be a representative. And it doesn't have to be for everything. You can say, literally, I just want you to designate the matters as FIRPTA related and for the tax year that we're dealing with. And that's all that they can really look at. But I think it's very, very helpful to communication and understanding what's going on, especially with this convoluted type of process. The IRS, this is a snip from the IRS LB&I section of the website. LB&I is Large Business International. They post what's called active campaigns. So they're telling people exactly what they're trying to audit or what they're going for. And basically what the IRS has done is they have done some research and some sampling and determined that there's what we call a lot of non-compliance for non-resident aliens and FIRPTA. And so they have a current active campaign where they are looking for people that are doing the things incorrectly or submitting things incorrectly. And they're going to be doing some examinations and audits of those folks. And again, as their staffing levels increase, these active campaigns will have more and more bite to them. So, you may think today, oh, there's nothing wrong with my situation, but a year from today, there could be a whole lot more activity going on because they have more staffing, more money, and more people in place. So we're getting close to the end, right at about almost 50 minutes here, and then I'm going to take some questions. But my takeaways are as follows. This is what I would advise any client. Always use a tax professional to do FIRPTA transactions, just because of all the convoluted rules and ways that the forms could go wrong. It's basically a one-shot kind of deal. If you get it wrong, then you're gonna have to suffer through 1 to 2 years of fighting the IRS to get your money back, which is never fun. I would work with someone that is dabbling in FIRPTA. And so if I'm selling a property as a non-resident or a G4, and someone buys it for me and they're saying, hey, we want to use withholding agent X. I then say, well, does withholding agent X have any experience with FIRPTA withholding? Do they know what they're doing? Had they worked with non-residents before? Kind of really quiz that person. Same thing for real estate agents, same thing for tax professionals. If they can't quickly tell you about FIRPTA and at least give you some general background about it from their experience, then probably not someone that you want to work with because they're likely dabbling. And if you do get a tax professional, I would tell you to get the 2848. If you don't have an SSN or an I-10, get one, if depending on which one you need to get. Be careful with the LB&I campaigns because, again, I think they're going to have a lot of bite. My prediction is about a year from now, we'll see a lot more activity with all of those campaigns. And you can literally look them up. There's a whole slew of them. It's LB&I, IRS LB&I active campaigns, and it'll take you to the webpage. Be be really aware of the COVID-19 disruption from 2020. Again, the IRS was shut down from mid-March 2020 to August 1st, 2020. And that shutdown has impacted them across the board on a lot of things, but particularly with FIRPTA. And so it's just a very slow cycle time and process. And then lastly, remember that the buyer that's buying the property is responsible for making sure that the withholding tax gets to the IRS, and there could create some issues there. So not only could you be a seller without your withholding tax refund, but you could have an angry buyer that maybe gets penalized and has penalties and interest for not remitting the withholding tax timely or at all. This is just some references to some other materials that could be helpful if you really want to get into the weeds for FIRPTA. Go to irs.gov. You can Google what I've listed there. IRM stands for Internal Revenue Manual, which is published online. Now they do black out certain sections that they don't want taxpayers to see, but I think these sections of the IRM, especially the Foreign Investment and Real Property Tax Act and the Form 8288 and 8288A, I think they're very, very insightful. They kind of tell you a lot about how the IRS is thinking when they're processing these forms. And then the Treasury regulations 1.897 and 1.1445, I think give really great examples of FIRPTA transactions. So if you're looking for something that's oddball or maybe something that's hypothetical, take a look at those Treasury regs. And then last, the CCA, which is the Chief Counsel Advice. I think that's a really good one for 1445. This is my contact information in case anyone needs to get a hold of me. You have follow-up questions that maybe we don't address during the webinar. The Wolf Group has a new address. We moved about a mile away, so we're now at 12701 Fair Lake Circle. And so if you need to get a hold of us, that's the address, but you can always call or email. And with that being said, let me get into some of these questions. I see that we have about 27 of them. Okay, so the first one is a question about repairs, renovations, and improvements. And so generally speaking, when you make a capital improvement to property, that can adjust your basis upwards. And in turn, that will lower your capital gain. Now, it has to be a capital improvement, not a repair. So again, a repair is going to be, fixing a toilet or changing out carpet. An improvement, a capital improvement, is something that's going to substantially change or alter the property. Perhaps new flooring, kitchen remodel, new roof, add on of a whole new section of the house. So those are the things. And again, if you're not certain as to whether it's a capital improvement or repair, that's where I think having a professional that's dealt with the calculation of capital gains tax for the sale of real property is definitely helpful to come in and kind of walk you through that. Okay. Why is it an enormous amount of time to get back withholding when there should have been none? Isn't it simply by filing a 1040 NR to report the sale? Well, what has to happen is that the IRS has to match everything up. They went through a lot of flack a couple years back by they got caught up in a scheme where a bunch of folks claimed to be non-residents, asking for a lot of refunds back, which they issued immediately. They used to issue these things really, really quickly. And they got slapped on the hand for issuing, I think it was somewhere in the neighborhood of like $80 million of refunds improperly. So $80 million loss to the IRS for doing that. And ever since then, they take a tremendous amount of time to make sure that the refund is correct and that it's going to the right person and that it's not part of a fraudulent type of scheme. So it's just a very, very long cycle time. And on top of that, you do have to understand that the IRS, their current staffing level is 1/3 less than where they were in 2010. So for over a decade, they've been operating with a very reduced workforce. Their budget hasn't increased. So imagine running a business and you lost 1/3 of your employees and your budget never increased. That's where they've been at for the last decade. And just now here in 2021, are they starting to see some relief under the new administration? They've already gotten some funds. They're going to get some more in the proposed Biden tax plan. So if you look at the US Treasury Green Book, there's a whole section about giving the IRS more funding to be able to, assist with cycle time increasing, enforcement activities, et cetera. Question, the inquiry says, I submitted Form 8288P 15 months ago. I still haven't heard from the IRS. What do you suggest? That's a very, very specific question. And that's one of the areas where it's some huge concern, right? You haven't heard anything back. Now, what do? I would say that's something we would have to take offline to really kind of figure out how to do that together. But But see, that is a concern that I have that I don't feel the IRS has really addressed properly. Okay. In the event the settlement company does not remit the funds within 20 days, who gets penalized? Is the seller liable? Is the seller liable for anything? Again, I haven't really seen this occur too much, but as I indicated, the buyer is responsible for the withholding tax. So if they don't remit it within the 20 days, it's the buyer that's the one that is on the hook for any kind of penalties. Okay, how can we get the withholdings back if the Form 8288 was filed without an I-10? That, again, is also a very specific question. I think you probably have to open up a taxpayer advocate case because what we used to do prior to COVID-19 is you would just pester the FIRPTA unit until they found the money, until they found the 8288A. You then provide proof of identity and they would link everything up together. Now that would take a really long time. There was one that we worked on for 3 years and we finally got them to link it all up together and it worked out beautifully at the end of 3 years. But now with COVID-19, I think you have to probably take that to the taxpayer advocate and really have them try to help you out as much as they can. That's a tough situation though, because I think those funds go into a black box and it can be very difficult to unwind that. Okay, what happens when the settlement does not comply with the requests that need to be sent to the IRS? Does the IRS have a mandate to communicate with the buyer directly to get the information pertaining to the refund? You know, again, I've rarely seen the IRS come back to the buyer and say, hey, there's this issue. So I'm not sure that there's a quote unquote mandate, but I think that if you read the rules and how they're laid out and how they should be enforced, you might see more of that on a go forward basis. But the settlement company does need to do their own due diligence and be aware of all the various rules related to FIRPTA so that they are complying under their kind of, you know, liability as a fiduciary to make sure that they're doing everything correctly. If one spouse is an American citizen and the other spouse is a Canadian or non-US citizen, should the non-US citizen spouse file Form 8288 for tax withholding tax? Again, you're not filing the form. No one is filing the Form 8288 or 8288A. That's the withholding agent or typically the settlement agent. But what happens, as I explained in my slide, the non-citizen or the non-resident alien would be subject to withholding tax on half the amount if the withholding tax is applicable based on the sales price. If property is owned by spouses, is there a need to fill out 2 8288A forms or just one? I like to do 2. I love to see 2. It's not necessary though. I've been able to do it with just 1. But typically 2 is easier because it makes it a lot cleaner when you're filing the non-resident returns, especially if both spouses are non-residents. You know, they have to do separate non-resident filings. I think it's easier to have the 2 8288A forms. Okay. In a separate package mail form W7, what does a separate package mean separate from what? Well, I think you need to go look at the instructions for that. There's a very specific way on doing the W7 with the 8288B. And I would probably, I'll be honest with you, if that's an issue that you're having with the I-10, I would probably use a tax professional to help you prepare your W7 and to make sure it's sent down properly in the right iteration. What happens if the sale is under 300,000, but the buyer does not want to commit to live in the property for the time period of 2 years? That's a great question. You know, I don't think the IRS really follows up to say, did you live in the property for 50% of the time over the 2-year period? That's the way the law is written. But I doubt the IRS has ever gotten that granular where they've come back and said, oh, your buyer didn't live in the property, but you know, they maybe converted it to a commercial, you know, entity or something. I've never seen that occur, but I would assume that what would happen is that the 15% would apply in that case if they did monitor that and they came back and said that the buyer is not conforming with the law. Okay, just to confirm, 8288 and 8288A are going to be filed by the closing agent. Is it strictly speaking not the seller's responsibility? Thanks. It's the buyer's responsibility. It's always the buyer's responsibility, but the closing agent does it as a matter of courtesy. They're the ones that are always responsible for that. That's part of the fees you're paying them, right? So you look in your closing statement, you're paying the closing agent, you know, fees to do all the stuff. You know, they got to work for something, right? To earn those fees. They're the ones that should do it, and they're the ones that always should take the lead on preparing those forms. State capital gains tax withholding exemption. Again, I'm not going to go into state withholding tax. That's very specific to the situation. As I indicated, that's something that you need to go directly to a tax professional for and have them analyze that because of the different types of state rules that apply to that. Okay. Can one submit the W-7 application alongside the Form 8, the 8288B form? Well, I answered that. There's a certain way that you're going to do that when you submit the W-7 and the 8288B. And again, the likelihood of that going through properly is quite low. So you need to try to put yourself in a good position to get that done correctly. Okay, what is the current timeline for the IRS to respond to the 8288B? We've been over 90 days and no response yet. Again, from my experience, and I'm always looking for people to tell me otherwise. I'm hoping someone comes back and says, hey, I got it in 60 days, I got it in 90 days. But right now it's 8 to 12 months. That's my general experience. I'm having people that we've done the work for last year come to me and say, hey, I just got this, what do I do? So again, it's a very, very long timeline. You do have to give it a little bit of grace. I think the IRS is giving everybody a little bit of grace. I think we all have to kind of look at that from that perspective, that it's not going to be the way it's laid out to be, the way the rules are, maybe a while before we get back to normal operating procedures on those forms. If a stamped 8288A is not received before the due date for a tax filing return, can you use a substitute to prove the IRS has the funds, such as a copy of the unstamped 8288A? Yeah, so we go ahead and file. Like I said, if we don't have the stamped copy, we just go ahead and file the non-resident return. We send in an unstamped copy of the 8288A. Now, in my experience, what they will do is they'll come back and say, hey, we got your request, we need the stamped copy. And at that time, hopefully you've got the stamped copy and you can give it back to them. But I would not slow down the request for refund. I'd go ahead and get that in and get that cycle time going, get someone to look at that and respond back to you. Okay. We are at the end here, and I think there are a couple more questions that I wasn't able to get to. I know that a lot of people have a lot of different inquiries that they have going on here. What I will tell you is go ahead and send over your questions, and I will put together responses to you when I'm able, and get those out to you probably next week. If they are general questions, I will respond. If they are not general questions, then we will not be able to respond, obviously, but we'll put those out and get those out to you next week when I'm able to. But I appreciate everybody attending. Hopefully you learned a lot about FIRPTA. Hopefully you learned a lot about the current climate at the IRS and how to deal with it, and it will help you with your situation on a go-forward basis. Thank you for your attendance.